Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. Hello, in today's video we'll be taking a look at the Friday, October 24th, 2025 trading session for the CBOE SPX index, and we will be utilizing the day trading GPS SPX Daily Key Levels indicator to trade SPX 0 DTE options, and we'll be specifically using the newest version of this indicator, which was just released a few weeks ago, the V2.0 version. Alright, so some of you may already be familiar with how this indicator works, but for those of you who are new to this channel who may have not seen any of our previous videos on how this indicator works, I will run through how the indicator works. The indicator works on two different SPX symbols on the TradingView platform. So one of those symbols is the symbol that you see the chart on now, which is the SPX CBOE symbol. So on TradingView, that would be, you would type in SPX, and then you would look for the SPX symbol that is under the CBOE exchange. And you would use the indicator on this particular symbol if you're trading SPX options. The other symbol that this indicator works on is the SPX 500 symbol, which we'll take a look at that chart now. Okay, so here is Friday's session with the SPX 500 symbol. So this you would type in on TradingView SPX 500, and then you would look for the SPX 500 symbol in TradingView under the 8-cap exchange. The difference in these two symbols is the SPX 500 8-cap symbol is a Forex CFD. So you would utilize the indicator on this particular symbol if for a couple different reasons. So one would be if you're not trading SPX index options and you are instead trading SPX via a Forex broker, specifically using it to trade the Forex CFD version of SPX and not SPX index options. An additional reason may be that you are involved in a Forex trading challenge through one of the trading challenge companies out there like FTMO, or one of the other ones like Apex. There's many dozens of them out there that offer trading challenges where you would trade on a Forex platform, either Forex currency pairs or indexes such as the SPX or metals, and you're trading, in the case of indexes, CFD versions of the indexes, and you're trying to pass a trading challenge to get a funded account with one of these companies. That would be another reason. And then the third reason would be if you are using the indicator for trading SPX index options. The reason why you would want to have a second chart opened on this particular symbol as well as the CBOE SPX symbol is in order to get the levels for CBOE SPX index 30 minutes before it opens at 9:30. So when you have the indicator on this SPX 800 8-cap Forex symbol, then as you can see here, there are two tables when it's on this symbol. So at 9 a.m., which is marked off this candle here, at 9 a.m. then you will see the new levels for the session, and you'll get these two tables here. This table is for specifically the symbol that the chart would be on, the SPX 500 8-cap. The levels on the chart are for the SPX 500 8-cap. However, this second table here displayed are the levels for the CBOE SPX main official SPX index that opens up at 9:30. So the reason you can't see the levels until 9:30 when it's on the CBOE SPX chart is because the CBOE SPX index is not open at 9 a.m. So even though the indicator knows what the levels are going to be at 9 a.m. for CBOE SPX, this is the only way that you can see the levels, because this Forex CFD does trade in the pre-market and overnight, so it is active at that time. And so via this table you can get a 30-minute jump on the session here for trading SPX index options by seeing what the CBOE SPX levels are via this second table here. Okay, so now we're back on the main CBOE SPX index. Okay, so at 9:30 a.m. Eastern New York time, you will get the new updated levels on the first tick at the 9:30 open. The levels that you will get as far as a default display are going to be the main SPX bull bear key price level for the session, which is abbreviated KPL, and we'll also be referring to that level during this video as the BBKPL. The default levels also are going to be the first midpoint level above the bull bear KPL, the first midpoint level below the bull bear KPL, as well as this QL level above and QL level below the bull bear KPL. You will also have the R1 main levels, the main R1 through R6 levels, which are also displayed on this table here, and the main S1 through S6 levels, which are also displayed on this table here. The additional midpoint levels you can enable in the user control panel. So as an example, because this was a bullish day, we also enabled the additional midpoint level between R1 and R2, the mid R1, R2 level here, and all the other midpoint levels are also optional to display by turning them on in the user control panel. As we explained at the beginning of the video, before the main video started, we do have links to descriptions of other topics on this particular indicator, one of which is the full-length features and setup video, which goes over all of the user inputs that are in the user control panel, as well as all of the features of this indicator, which we're not going to go into in today's session. If you'd like to see that features and setup video, as well as how discussing all the various inputs and customization that you can do with this indicator, then please go to that video, which is in the description of this video, and you'll see a link to that, as well as we discussed in the preview to this video, links to other topics concerning other various topics regarding this indicator. Okay, so as you can see here, we have this table here. You're not seeing some of these other levels here because we have zoomed in to the R3 level, to the S3 level, so we could also see this YDL level here. And usually when you're using this indicator, as explained in one of the other videos that's also in the description about how to set up your display at the beginning of a session, you usually want to zoom in on either the R3 through S3 or R2 through S2 levels at the beginning of a session, so that you can see more of all the other levels in between on a more granular view, because in 90-95% of the cases, most of your trades at the beginning of the session are going to be based on this bull bear key price level. So it's important to see a more granular view of the R2 through S2 levels, or R3 through S3. You do that by simply expanding out your price axis table by moving it and expanding it, and then that will, instead of having the levels squunched up, it will make them more spaced out, as you see here. Also, this table here is also optional, that you can turn it off if you do not wish to have it on, because you do have the line labels for the various levels here. So it's optional to turn on. It is on by default. However, you can turn it off if you wish to not have it on your chart. You can also, if you do have it on your chart, you can move it to different areas of the chart depending on where you'd rather have it placed. Today, since we have this price action over here, we prefer to have it over here so it doesn't get in the way here. Okay, so also you'll see a second table here which has the SPX PMH, SPX PML, SPX YDH, SPX YDL, and SPX YDC key levels. And you can also see those levels here on their respective price levels as far as their individual line labels. So what these represent is the PMH is the pre-market high for today's session. For SPX, the pre-market low is the PML, which is down here, and it's very close to the YDH. So you'll see in a case like this where they're very close together, you either have to expand out your chart more to see it when it's closer together, or this can be a reason to leave this particular table on your display, because when they are very close together, like you'll see here for the YDH level and the PML level, then you can ascertain the exact price level for both of them, as opposed to here where it's kind of hard to tell because they're very close together. So the PML is pre-market low, PMH pre-market high. YDH level, that is the previous day's or yesterday's daily high during the RTH session. The YDL is yesterday's daily low or the previous day's RTH session low. YDC is yesterday's daily close, the previous session's RTH session close, which you'll see here. Okay, so as you can see here, we did have a significant gap up due to the news that came out at 8:30 regarding some of the government data. We did get a significant gap up for the market today. This is the 9:30 opening candle here for today's session, and this was the close from yesterday's session. As you can see here, it did open below the bull bear key price level, crossed over the bull bear key price level, and closed above the bull bear key price level on the opening 9:30 a.m. candle. Now we're on a 2-minute chart, so another thing you need to know about this indicator is it works on time frames, on chart time frames between 1 minute and 30 minutes. So the minimum chart time frame is 1 minute. The maximum chart time frame that this indicator works on is the 30-minute chart time frame. If you have the indicator set to a time frame above 30 minutes, such as an hourly, then there will be a disclaimer that will come on the chart displaying a message that you need to put your indicator back to a chart time frame between 1 minute and 30 minutes. Now for the strategy that we put on our videos, if you've seen our other videos, this is the same strategy that we'll be going over with today. On this particular strategy, this is an intraday trading strategy. So this is a day trading only strategy where you're opening and closing the positions all in the same session. So you're not holding any positions overnight. This is not a swing trading indicator. This is a day trading indicator where you are opening and closing positions all in the same session. And with that in mind, the time frames that are the best to use for this particular strategy to be used with this indicator are going to be the 1 minute time frame to the 5 minute time frame. And if you've seen our other videos, you'll see that we always show the 2 minute time frame, because that is the time frame that we have found to be the best for between the 1 minute and 5 minute for this particular strategy. You may find then using this indicator that you prefer the 5 minute or 3 minute or 1 minute over the 2 minute for your own purposes, but we have found that the 2 minute works best for this particular strategy. And this strategy is simply buying call options, 0 DTE call options on bullish entry signals, and on bearish entry signals, simply buying put put options. There are people that do use this indicator for other strategies besides the strategy that we normally employ, which we're going to show again today. And those strategies may range from using iron condors, or using butterflies, or using other types of combination option trades. That is not the strategy that we employ. We simply buy call options on bullish entry signals, and we're simply buying put options on bearish entry signals. However, there are other traders that use this indicator successfully on other types of option strategies, and if you're using those other types of option strategies, you may find that the longer time frames of, say, 10-minute, 15-minute, or 30-minute chart time frames may work better for you for those particular other types of option strategies. But for the strategy that we normally show in all of our videos, which is the same one we'll be showing today, the 2-minute time frame works best, or the other time frames you could utilize would be the 1-minute through 5-minute chart time frame. Okay, as you can see here on this opening 2-minute candle here, as I explained earlier, we do have the gap up, significant gap up from yesterday's close, and price opened below on this candle, traveled and crossed over intra-candle the bull bear key price level, and then closed above the bull bear key price level. And if you're going to take a trade off of the opening 9:30 a.m. candle, then this is your bullish entry signal. So the main point about this bullish entry signal for the opening 9:30 a.m. candle is not necessarily where it opened, it is where the candle closes. Because it could have opened down here, traveled above, and then closed the candle below the bull bear KPL. And if that was the case, that it actually closed below the bull bear KPL, then that would have been a bearish entry signal. And instead, if we were taking the trade off of the 9:30 a.m. opening candle, we would instead be looking at a bearish entry signal. But in this case, we have a close above. So if you're taking a trade with this indicator off of the 9:30 opening candle, then the key is, where is it closing? And that also means that this candle could have opened above, stayed above, and closed above. It would still be a bullish entry candle. So it doesn't necessarily have to cross over or where it starts and opens the candle. The main point is, where is this candle closing? And the same thing is true in the reverse. It could have opened below, stayed below, and closed below. The main point is it is closing below. Now, we do also have a video on, are there instances on the 9:30 a.m. opening candle where you would not take the opening candle trade, even if you were usually inclined to do so, even if it closed above or below the bull bear KPL on that opening candle. And yes, there are some instances where you would not take that opening candle trade, and we explain those how to recognize those instances where you would not, and what is the definition of what to look for, and how to recognize where you would not take those opening candle trades, even if it closed above or closed below on the opening 9:30 a.m. candle. And that video that goes into more detail about that is in the description of this video. So if you'd like to see more information on the instances where that happened, only occurs a few times a year out of the 250 so trading sessions there are in a year. But we do have that video on how to recognize when to not take that opening candle trade. So if you'd like to see that video that goes into more depth about that, then look in the description of this video for that specific video. Alright, so let's get on with it here. So we have the 9:30 a.m. opening candle. We have the bullish entry signal. If we're going to take this trade, our trade is occurring off of the bull bear key price level. We have a bullish entry. So now we have our process of determining which option strike we're going to use, which specifically, since this is a bullish trade, which call option strike we're going to use for this particular trade. So on any given trade that you have with this indicator, regardless if you're taking a trade off that's triggered by the bull bear key price level, or if you're taking a trade later on in the session, whether it's a bullish or bearish trade off of any of the other main R&S levels, which with this indicator you can take trades off of any of the main levels, which the main levels are the bull bear key price level and the R1 through R6 levels and the S1 through S6 levels. So you're not taking trades off of the midpoint levels, those have a different purpose, or the QL above or below levels, those have a different purpose. It would only be off either the main R levels or the main S levels or the main bull bear key price level. And we do have a video on how to take trades off of the other main and R levels and S levels throughout the rest of the session. Typically in the first opening moments of the session, most of the focus is going to be, and most of your trades, if you do take any trades, they're going to be based on the bull bear KPL, which that is the case that we have today. If you do want to see the video on how to take bullish and bearish trades off of any of the other main R and S levels, we also have a link to a video in the description of this video on that particular topic. Okay, so as stated, we have 3 different options that we can use on any bullish or bearish trade off of either the bull bear key price level or either the main R or S levels. So what are the factors in determining what strikes you would use based on the level that you're trading from? In this case, the trade is based on this 9:30 a.m. opening candle, and the trade is derived from this bull bear key price level. So the 3 different options that you can use would be as follows. The standard play is going to be using the at the money strike that is closest to the level that you're taking the trade off of. In this case, the level we're taking the trade off of is the bull bear KPL, which for today's session is 67.7850. So it's a bullish trade, so we're looking for call options. What is the closest call option strike in SPX to 67.7850? And that is going to be the 67.80 call option. If, for example, the bull bear key price level was, say, 67.77 instead, then the 67.75 would be the closest strike. But in this case, it's over the midway point between strikes. For those of you not familiar with how SPX option strikes work, SPX option strikes go in 5-point increments. So for example, 67.70, 67.75, 67.80, 67.85, etc. So this 67.80 call is the closest strike to the level that we're trading from, the bull bear key price level 67.7850. So that would be your standard play, an at the money call option on this bullish entry signal from this level. However, there are 2 out of the money strikes you can consider, and how we do have another video that does go into more detail about how to do this on other main R and S levels as well. As far as determining it, it's very similar to what we'll be going over now for the bull bear key price level. So if you want to see that video, you can look at that in the link in the description of this video. Alright, so how do we determine the other 2 out of the money strikes that we could use on this particular trade if we were so inclined not to use the at the money standard play? And it's pretty simple to go through the process. So you simply look, since we are having a bullish entry signal here, we look above. The first out of the money strike that you consider is the first midpoint level above the level that you're trading. This is the level we're trading. The first midpoint level above is this mid BBKPLR1, 67.8765. Now, this is slightly over the midpoint between the 67.85 and 65.90 strike, because right in the middle is 67.8750. So this is right over the midpoint. So the closest strike to this level is going excuse me, is going to be the 67.90 strike. So you look to on the bullish trade, the first out of the money option that you could consider using would be the first midpoint level above the level you're trading. In this case, it's this level here, since we're trading this level, 67.8765. The closest strike is the 67.90 call option. The furthest out of the money strike that you can consider is going to be on a bullish trade is going to be what is the first main level above the level that you're trading on this bullish trade, and that's going to be, since it's this level we're trading from, the R1 level here, 67.9679. So in this case, the 67.95 call option is the closest to this level. So that would be our furthest out of the money strike that you can consider is going to be one full level away in the direction that you're trading. In this case, bullish direction, so it would be this. If instead this was a bearish entry signal, then we would do the reverse. We'd be looking at an at the money put of 67.80 for the standard play, and instead on the bearish play, we would look below, and then we would look for the closest put strike to this first midpoint below, and our furthest out of the money strike we would consider would be one full level below and use the closest put strike to this level. Okay, so now that we have our three different strikes that we can consider, typically it's best to use the at the money strike with this particular strategy. However, there are some advantages to using the out of the money strikes, one of which is obviously cost. The cost of an out of the money strike is going to be a lot less, as we'll see in the examples here. And so you will have less overall money debited from your account, and you will have less money at risk as well. However, the out of the money strikes are going to require that SPX move more in the direction that you want it to move in order for you to make the same amount of money that you would with an at the money strike. So there are pros and cons with using each of these. As far as the at the money, it's going to cost more to begin with, so it's more being debited from your account. The out of the monies are going to be less debited from your account, as you'll see here in a second. And so you have less at risk, but they will have to move more in order to make the same amount of money. Okay, so we know which strikes that we can consider, but what about a stop loss? The way you determine a stop loss with this indicator is you take the level that you're trading from, in this case the bull bear KPL. What is the entry signal? Bullish or bearish? In this case, it's a bullish entry signal. So our stop losses are going to be, that we have to choose from, are going to be either using the QL level below the level we're trading or the midpoint level below the level we're trading, since this is a bullish play. Now, what are the differences between these two levels? The midpoint level is going to be your standard stop loss on a bullish play from this level. If instead we were doing a bullish play from the S1 level, then the standard stop loss would be the midpoint level below S1. So it would be the mid S1, S2 level. But we're taking it from this level, so it's the midpoint level below this level. That's your standard stop loss. It's typically recommended to use the standard stop loss versus the tight stop loss. The tight stop loss in this instance would be the QL below the BBKPL level. And the difference between the two is obviously the tight stop loss is going to give you less overall risk. However, it is going to be more prone to being stopped out. That's why it's the tight stop loss. So you just have to keep that in mind. Some people prefer using the tight stop loss, knowing that it is more prone to getting stopped out. And in their mind, they would rather have less at risk. If they get stopped out, then they'll just look for a re-entry signal and then enter another trade, whether it's on this level or a different level. And they prefer that methodology in using this particular indicator. But the preferred method would be using the standard stop loss. However, that's up to each individual trader and their risk profile of how they like to do their trades. If instead this was a bearish play and we were instead looking at puts, if we had the exact reverse situation and this had closed below, we had a bearish signal, then our tight stop loss would be the QL above the level we're trading on that bearish put play, and then our standard stop loss would be the first midpoint level above the level we're trading on the bearish play from this level. Okay, so do you use the same stop loss depending on whether you're using an at the money option or one of the two out of the money options? And the answer is yes. The stop loss remains the same because the stop loss is based on the level that you're taking the trade from. So the stop loss would be the same whether you're using the at the money call strike in this instance, since it's a bullish play, or you're using one of the two out of the money strikes that you could have considered. The stop loss, the initial stop loss that you're using on those trades is going to be the same regardless of which of those strikes that you're using. All right, what about the cost? You're waiting until the candle closed to enter this trade because we said before, if you're going to take a 9:30 a.m. opening candle trade, which there's no rule with the strategy that you do have to take the 9:30 a.m. candle opening trade. If you prefer, you can simply wait for price action to play out. Some people prefer to let the first 5 minutes, 15 minutes, 30 minutes, or hour play out, and then they prefer to then look at where price action is and then decide which level they want to take, which main level they want to take their bullish or bearish trade from, as opposed to using the 9:30 a.m. opening candle or taking trades in the first few minutes of the session. That's completely up to each trader to decide for their own process in using this indicator of which process that they prefer to utilize. Some people are not able to be at their desk at exactly at 9:30 because they have other obligations. So just by design, with the way their daily schedules are, that they have to use the indicator later on in the session anyway, because they're not even there at their trading desk at 9:30 because of other obligations. So it really just depends on what you prefer. That is the method that we prefer to use it on, where except for the, as I said earlier, the few instances a year where you would want to avoid the 9:30 a.m. candle, and we have, we have the video on how to recognize that when it does happen, the few instances a year where you would not take the opening candle trade. That's in the description of the video. But so anyway, let's just get right into the three different options here. So the 6780 0DTE call on the close of this 9:30 a.m. candle. Remember, waiting for the close, because if this ended up, we're not entering this trade intra-candle. We're going to wait to the close of the candle. I mean, you could wait a few seconds before the close of the candle to go ahead and enter it, but we're waiting for the close of the candle to make sure that it is closing if we're taking this 9:30 a.m. opening candle trade, that it's actually going to close above or below the bull bear KPL, because then that's determining whether it's going to be a bullish or bearish entry signal. So on the close of the candle, it is $14.10 for this at the money 6780 0 DTE call. You can use 1 DTE calls with this indicator, or 1 DTE options, excuse me, instead of 0 DTE. Our preference is 0 DTE. If you prefer 1 DTE options, then you can look at how you can look at your own broker for the data boxes for these particular times, and also when it hits the different levels later on in the session as to how those would have worked out as far as cost and profit later on in the session versus the 0 DTE. The main thing you have to keep in mind is that you are going to be opening and closing the positions all in the same session, sometimes just a few minutes later, as was the case today. Sometimes it may be an hour or two later, but you're not holding any positions overnight. You're not holding any positions day over day. So you're day trading and opening and closing the positions all in the same session. So it does not make sense to utilize, for example, options that are going to expire several days from now or a week from now, because then you're paying a whole lot for time premium, which is not even going to come into play if you're opening and closing during the same session. So 0 DTE is preferred. However, you can also consider using 1 DTE if for whatever reason you feel more comfortable using 1 DTE. All right, what about the 2 out of the money strikes? Our first out of the money strike, remember, was the 67.90. So on the candle close of this 9:30 a.m. candle that closes at 9:32, $8.90. So as you can see, that is quite a big difference between the $14.10 for the at the money. We're only paying $8.90 for this. Now, for those of you who are not familiar with how options work, most of you, I'm sure, are already, but for some of you who may not already be familiar with how options work, the cost of one option is going to be the price of the option that you're paying times 100. So on the at the money, that's $14.10. If that's the price you get executed at, then you multiply that times 100. That would be $1,410. So that is the price of one call option. If the price was $8.90, as in the case of this out of the money one, then your cost for one option is going to be $890. If you were buying 10 of these options up here, then you would multiply 100 times this figure, and then you get $1,410, and then you're buying 10 of them, so it'd be $14,100. If you were buying 2 of them, it'd be 2 times $1,410, so it'd be $2,820. All right, the furthest out of the money strike was the 67.95 strike. The 67.95 strike was only $6.90. So that would be $690 per call option. So as you can see here, the furthest out of the money strike is less than half the cost of this at the money strike, whereas the one that was the other option was only $8.90, and that is about $530 less, or $520 less, excuse me, than the cost of the at the money. So as you can see, there is a significant price difference between them. So again, that is something for each trader to go over for themselves when they utilize this indicator as to which strike they prefer using, whether they prefer using the slightly out of the money strike, the furthest out of the money strike, or the at the money strike. And we'll see how these strikes play out. We also have in some of our other videos, we don't do this for every session, but there are a number of sessions where we do compare like we are doing today, how the at-the-money strikes work out as far as cost versus how they move through the session versus the at-the-money. Alright, so now we have that. As we stated, no matter which one of these you use, it's still the same initial stop loss you're using, because your initial stop loss is based on levels, depending on, and those levels are depending on which main level you're trading from. In this case, the bull bear KPL, and since it's a bullish trade, we have the QL below for our tight stop loss and the midpoint below for our standard stop loss, regardless of which one of these strikes we're using. Now, what about target exits? The target exits depend on a couple of different factors. One is obviously the level that you're trading from. The second thing is going to be what type of trade that you're executing. Are you doing a scalping trade only, or are you doing a regular trade? So that's how we define the difference in the two trades utilizing this indicator. So before you place a trade, you should already have in mind whether this trade is going to be for you a scalping trade or a regular trade, or for you to decide in general, is every trade that you're going to make going to be a scalping trade or a regular trade. Now you can mix and match them. You could say, okay, on this trade I'm going to do a scalp. Next trade I'll decide whether I'm going to do a scalp or a regular trade. But you just need to know what the differences are as far as a target exit and some other factors, so that when you are entering into a trade, you will know what your target exit is, and then what your other options are as far as price proceeds in your favor, depending on what type of trade you're doing. So with a scalping trade, we'll go over that first. On a scalping trade, with this indicator, you are looking for a one level move in your favor, and then you are exiting the trade. You're not doing any stop loss adjustment. You're not staying in the trade after that point by adjusting your stop loss or scaling out or anything. So when using this indicator, if you're just scalping only, you're looking for a one level move in your favor for the exit, and then you're going flat. You're exiting all of your contracts, whether you're trading one contract, 5 contracts, 10 contracts, 20 contracts, or what have you. So with the scalp, you're exiting only when the target is met. Now, how do you determine a one level target? Is as follows. So you take the level that you're trading from, what type of trade it is. In this case, we have a bullish trade. We're trading from this level here. We have a bullish trade, so we're looking one level above. That's our target exit. If instead this was a bearish trade, then we'd be looking one level below for a scalp target exit. If we were taking instead a bullish trade off of R1, then we would be looking one level above for our target exit on a scalp. If we were instead taking a trade later on in the session, not in this particular session, but another session where R2 would come into play, and we decided to take a bullish trade off of R2, then one level above for a scalp would be R3. Same thing in reverse. If we took a bearish trade off of S1, then we'd be looking for a one level move on a scalp and exiting at S2. If we took a bearish trade off of S2, then our scalp exit is S3, because that's one level below. If we were taking a bullish trade off of S1, what is one level above? That's the bull bear KPL. If we were taking a bearish trade off of R1, what is one level below R1 on a scalp? It'd be the bull bear KPL. Okay, so in this case, a bullish trade off of the bull bear KPL, one level above for a scalp exit is the R1. And as you can see here on the 9:36 a.m. candle, the wick of this candle, intra-candle, hits the R1 level. So that would be where you would exit the trade on the touch of this R1 level. As you can see, it did back off and close off of this R1 level slightly. Then it later on it did go back up. Now in this case it did return back up, and then it not only touched it again, but it closed it again up slightly above it. As you can see here, it also wicked above it here and then closed below it. Then it hit it here again and closed slightly above it after wicking above. Then here it wicked above and hit the PMH level on the wick, but ended up closing below it. So in a scalp, you're looking for that first touch. I mean, this candle could have closed above it, it could have closed light on it, so you're ideally looking to exit when it touches on the scalp. If you ended up missing at that time, then you did, on this particular session, you had several more opportunities to get out of the trade, as you saw in today's session. So, you know, if you were going to the bathroom or getting a cup of coffee and just didn't happen to see it, then in this particular case, you did have you had several other opportunities to also get out of your scalping trade, because as we know, when you're trading, you can be watching the screen and then something comes up. Either your doorbell rings, the phone rings, you go get a cup of coffee, you go to the bathroom, you do something. You know, you can't be watching the screen every single second, because there are things that do come up. So there are brokers that, for example, Thinkorswim is a broker that offers this feature, and also Interactive Brokers offers this feature, where you can actually set stop losses and take profits based on the underlying price instead of the price of the option. So for example, with Thinkorswim or with Interactive Brokers, now other brokers may offer this as well, many do not. This is an important thing to also consider when using this indicator, that if you do have a broker, it would be better to have a broker that does offer this feature, so you have it available to you if you prefer to use this feature. And that is, you can set a take profit based on SPX trading, meaning the underlying SPX trading a certain price. So you could have set a take profit based on SPX hitting 67.96.79, and then it would automatically trigger the closing of the option at when it hits that particular price level. Same thing with their stop loss levels. They have a feature where you can also set the stop loss levels by the underlying price as opposed to the price of the option. So if your broker does not have that feature, then yes, you're going to just have to watch the screen, and you're going to have to get out when you see it touch that level. And the same thing with their stop loss, you're going to have to watch the screen, and then when it touches the level, then you're going to have to manually stop yourself out. It's a lot easier to use a broker that does offer those features. Not every broker does. And if you've never used that type of feature before, then obviously you'd like to you need to try it out on a demo account for a decent period of time to get used to using that feature if you've never used that type of feature before. So there's also a link to a video regarding this feature in Thinkorswim that's in the description of this video that does talk about. That's not a video that we made. It's a video that somebody else made that was a very good video on that topic, and they do a very good job of explaining it. So I invite you to take a look at that video, which is also in the link to that is found in the description of this video. As I said, the Interactive Brokers also has that feature. The Interactive Brokers platform, many people swear by it and like that platform. It is in my opinion, a very difficult platform to utilize. It's very cumbersome. Some people, though, swear by it. If you like it and prefer that one, They do have that feature as well. There could be other brokers that have it. I'm not aware of other brokers besides those two that have those features as far as stop losses and take profits based on the price of the underlying. Your broker may have that feature, so you should ask them about that and ask them how to use it if they have a section in their website on how to use it if they offer it. Okay, so let's look at how these worked out on the scalp. So again, scalping, one level move in your favor, one level move defined by the direction that you're trading, the level that you're trading, and one level in that direction. All right, so on the wick touch, now I've done both prices here so you can see the difference between the wick touch of the level versus the close of the candle, which backed off. So on this, the at the money 67.80 on the wick touch of the R1 was 25.40. So that is a profit of $1,130 per option. However, on the candle close after backing off, it was $24. So that's a $990 profit per option. So you can see the difference between the two there. The slightly out of the money 67.90 call on the wick touch of R1 was $18.20. So that is a $930 profit per option. On the candle close after backing off, it was $17, so that's $810 profit per option. The furthest out of the money, $67.95 on the wick touch of R1 was $14.90, so that is $800 profit per option, versus the candle close was $13.80, and that would be a $690 profit per option. We'll take a brief look when we get through this section of the video at the Thinkorswim data boxes for these timestamps as well, so you can see those for validation purposes, but because there's just not really enough room to put them here on this chart. Alright, so that's your scalp. You can see the difference in how these options reacted. As you can see, this was just basically just a couple of candles later, you're already out of this trade if you're scalping. So with scalping, like I said, you're 100% close out off of the one level target move. There's no adjusting your stop loss. There's no scaling out. You are simply closing out 100%. As you can see, there was no jeopardy of either one of these stop losses getting hit. So we just had a straight rocket right up to R1. All right, so what about a regular trade as opposed to a scalp? A regular trade with this indicator differs because in a regular trade, you're looking for a minimum 1.5 level move in your favor for you to then have several options as to what to do at the point that it hits the 1.5 level move in your favor. Now, a 1.5 level move is the minimum required move for a regular trade as far as either exiting the trade or using one of your other options that you have as far as adjusting your positions and stop losses if you choose to do that instead of exiting the trade at the 1.5 level move in your favor. A 2 level move in your favor is considered the ideal minimum move for a regular trade. So how you determine a 1.5 level move, and if you've seen our other videos, you'll see where we didn't get a 2 level move today on this particular trade. We did get the minimum required 1.5 level move, but if you watch our other videos on other SPX sessions, then you'll see moves where we've had the ideal 2 level move as well as obviously the 1.5 level move on regular trades, and also sessions where we've gotten levels that in some cases go up to 6 or 7 levels. But in this case, we did not get that type of move today, but however, we did get the minimum required 1.5 level move, and that happened on the wick of this candle here at 11:24 a.m. candle. So same thing, it backed off after having the wick touch, then went up again, and you had several instances throughout the session where if you missed the initial one, where you could have gotten out again, as we saw playing out through the rest of the session. Remember though that in trading 0 DTE options, as the session moves on, anything that you're holding earlier in the session, the time value, if there's any time value left in that option, it's going to start evaporating. Especially after lunchtime, it starts evaporating quickly. So even though the option is worth X amount up here, later on in the session, it's going to be worth less than it is here because of whatever time value was left here starts rapidly evaluating as the session progresses. If it was way in the money and there's no time value and it just hung around the same level for the rest of the session, then that would not be the case. But if it's not extremely far in the money, there is going to be still a time value. So that's something you need to be cognizant of. Again, that is a reason why some people that use the indicator prefer the 1 DTE options if they're more inclined to hang on to the option later on in the session. That is one advantage of the 1 DTE option, is that time value expiration is going to be less than the time value expiration would be on the 0 DTEs. So that's also something to keep in mind depending on what sort of process that you utilize with this particular indicator in the version of the strategy that you prefer to use. Okay, so again here we have both the wick touch and the candle close marked off here, what the difference is between getting out at the touch of this level, this 1.5 move, versus the candle close. Now 1.5 level move, it's basically the same process that we used for the scalp. So it's a 1.5 level move in the direction from the level that we are trading from. This is the level we're trading from. This was the 1 level move here for a scalp. So 1.5 level move is simply the midpoint level above this 1 level, the mid R1, R2. A 2 level move from this level would be the R2. All right. So that's the 1.5 level move from the level we're trading. The 67.80 at the money call and the wick touch of this mid R1, R2 is $29. So that's $1,490 profit per option. If you instead got out on the candle close, it's $27.10, so that would be $1,300 profit per option. The slightly out of the money 67.90 option, if you use that one, then the wick touch of the mid R1, R2 was $20.70, so that's $1,180 profit per option. If you instead wait until the candle close, then it's $18.90, which is $1,000 profit per option. And lastly, the 67.95 calls on the wick touch of mid R1, R2, $16.70, so that's $980 profit per option. And if you didn't get out till the candle close, it's $14.80. That's $790 profit per option. All right, so that would be if you're closing out all the contracts, how that works out. However, on regular trades, you do have the option of not closing out all of the contracts, and instead you have the following options. One option is if you prefer to not close out any of your contracts, you can just adjust the stop loss on your contracts at this point to either break even or break even plus an initial 10 to 15% profit buffer on top of the break even. Your other option is that if you're trading multiple contracts, you would have the option to close out 70 to 90% of the multiple contracts that you're holding. And then on the remaining contracts left over, then you would adjust your stop loss to break even or break even plus the 10 to 15% profit buffer on any remaining runners that you have. That way, you're closing out the vast majority of your options because you've been trading multiple contracts, and you're getting the full profit of this 1.5 level move on the 70 to 90% that you're closing out. Then on the remaining contracts that you have left over, you've adjusted your stop loss to break even or break even plus 10 to 15%. So if you do happen to get stopped out on those remaining runners, then, and we don't get really a further significant move in the direction that you're trading, then at least you got out the majority of the profit on the overall position because you closed out 70 to 90% of the multiple contracts. Now, what do we mean by multiple contracts? Typically in this 70 to 90%, it typically means 4 or more contracts. So for example, if you're trading 4 and you sell 3, that's 75%. 3 is 75% of 4. If you're only trading 3, 3 would be if you only had 3 contracts and you sold 2 of them, that's basically 66.67%. So it's technically under the 70%. It's pretty close to it. If you had 5 contracts, you sold 4, that would be 80. If you had 10 contracts, then 70% would be selling 7 of them. If you had 20 contracts, 70% would be selling 14 of them, as an example. If you had 15 contracts, 70% would be basically 10. And for example, going back to the prior example, 10 contracts, selling 9 of them would be 90%. And on 20 contracts, selling 90% of them would be 18 of them. So it really just depends on how many you're trading. Now, if you're only trading 2 contracts, then you should just close out the contracts or adjust your stop loss on them. If you're really only trading 1 contract, then you can't, like I said, 1 or 2 contracts. If you have 2 and you sell 1, that's 50%. That's not good enough. So if you only are trading 1 or 2 contracts, then really there's only 2 choices on regular trades. Either you have to close out 100% when it hits at least the minimum required 1.5 level move, or you're going to have to adjust your stop loss to break even or break even plus the 10 to 15%. Because it doesn't meet the 70, when if you only have 2, you can't meet that 70% threshold. So if you're only trading 2, then you need to treat it just as if you're trading 1. So it's either get out of all of them or adjust your stop loss on all of them. Typically, if you're only trading 1 or only trading 2, then you're probably better off at the 1.5 level move just closing them out. Really more of the adjusting to break even and scaling out and all that, that's really just better for the process of having the correct amount of multiple contracts. And really everyone's account's different. There's some people where trading 10 contracts on every trade is no big deal because they have a very large account. Or trading 5 contracts. Not everyone's account size, everyone has a different account size. Some people's account size, they have enough to trade 40 or 50 contracts per trade. Most people, that's not the case. Most people are probably more in the 1 to 5 contract range. So with obviously the vast majority, more people in the 1 or 2 contract range. So that's why you just have to understand the differences. Everyone's situation is different. Everyone's risk profile is different as far as how much they're willing to risk based on their account size. So the main thing that you want to keep in mind, though, is, as we pointed out, when you're making this stop loss adjustment here, remember our initial stop loss was based on levels. In this case, since we're trading off of this bull bear key price level, we had a bullish trade. Our tight stop loss is this level, and our standard stop loss is this level. However, when you're adjusting your stop loss, when it hits on a regular trade, when it hits this minimum target, or it hits the ideal minimum target of 2 level, then at that point you're switching to now your stop loss to break even, or break even plus the 10 to 15% buffer, is now going to be based on the price of the option. So for example, if we were just adjusting it to break even on this at the money call, we paid $14.10. So it was based on a level here, but here now we're going to adjust it to break even. Now we're going to adjust our stop loss to break even, which means now our stop loss is going to be what we paid, $14.10. Or if we were instead trading this option, we would adjust it to break even at $8.90, or this option we adjusted to break even of $6.90. If you're adding a profit buffer of 10 to 15%, in the case of this one, you take $14.10, you add 10% to it. The real quick math is just, this is $14.10, you just add $1.40 to it, so that would be $15.50. If you're adding 15%, then you just get 15% of $14.10, and you add that amount to the $14.10. On this one, what's 10% of $8.90? It's 89 cents, but you just round it to 90 cents real quickly. So you would add, if you're doing a 10% profit buffer, now this 8.90, you add 90 cents, that now becomes 9.80. Here, 6.90, what's 10% of that? That's 70 cents. So you add 70 cents to this, and that would be 7.60. If instead you're doing 15%, then you just calculate what the 15% would be, and if necessary, you'd round it up or down to get to the closest amount. All right. Why aren't you adding more than 10 to 15%? Well, on an initial, if you're not going to do break even and you instead want to add a profit buffer, on an initial adjustment, when it hits the minimum required level on a regular trade, if you add too much of a profit buffer, you're not going to give it enough room to play out, because in a lot of cases you're going to see price retrace, and if you put, say, a 50%, if your initial profit buffer is 50%, like say you change this and you added $7 to it, and made it, for example, $21, well, that's typically, now that's not going to be this case every time, because there can be times where you put 50% on it and it worked out and it just went up higher and higher, and it was no big deal that you added 50% to it. But in a lot of cases it is going to be a big deal, and it is going to stop you out because you're adding too much of a profit buffer on an initial adjustment. Of course, that's completely up to each trader. If you want to do something different, that's on you. If you prefer a different method that may work better for you, then you, of course, are free to do that if you prefer to do that. However, just in our experience, on an initial adjustment, if you're going to do something besides break even and do a profit buffer, generally speaking, it's best to do the 10 to 15% on an initial adjustment and wait till the trade on any remaining runners that you have goes way in your favor. It goes up to where now we have a 3-level or 4-level move in your favor, or a 2.5 level move in your favor, then adding more and more of a profit buffer as it continues to move in your favor. Level to level trade management. So you're not going to keep, as it keeps moving in your favor, if we had a session where it kept moving in your favor and we had on this mid R2, R3 and it kept moving up to R2 and then mid R2, R3 and then R3 and then mid R3, R4 and then R4, obviously you're going to be adding, but you're going to keep adjusting your stop loss. If you decide at each level, you have another decision to make as it keeps moving in your favor. Do I close out all the remaining contracts, or do I make a further adjustment to my stop loss? So at each time it moves up, you have that same decision to make. And if you are going to keep some contracts as runners, because you could have multiple runners, like you could, as an example, if you had 10 to start with, you sold 70% of them, now you've got 3. So you could close out 1, now you've got 2. Adjust the stop loss to the remaining 2. It goes up another level, I sell one of those 2, now I've only got 1 left. And I want to keep that one intact, and I'll just adjust the stop loss on that. So it's really just up to you, and it really just depends on how many runners you have left, whether it's an all or nothing proposition. Obviously, if you only have 1 runner left to begin with, then it becomes an all or nothing proposition as it continues to move in your favor. So the point I was trying to make, though, is that if you had too much of a profit buffer to begin with, you might as well just close all your contracts out, because in a lot of cases you're just going to get stopped out, and then you're just giving up profit that you would have had on those remaining contracts by just closing them all out. And that would be the case if you added too much of a profit buffer to begin with. There's a high likelihood that those are going to get stopped out, at least on on an initial one. So that's just an observation from lots of years of trading. Of course, like I said, that's completely up to you. If you prefer a different method and you prefer that I just rather put 50% on profit buffer on any remaining ones, and you prefer that method, then you're more than welcome to use that method. And everyone has their own process and their own methodology off any strategy that they end up employing. So you may find that works better for you for your own purposes, and if that works better for you, then certainly use that type of adjustment if that works better for you. All right, so we've gone through everything here. Now we're just going to take a quick look at the Thinkorswim data boxes for the 3 different options. Okay, so first we're going to look at the 67.80 at the money, 9:30 a.m. This was the entry candle. These are 2-minute data boxes. $14.10. Here was the 1 level move scalp at 9:36 a.m. Here you have the high, $25.40, close $24. Here's one of the candles later on. Now we did kind of point this out, but not the particular timestamp. So just a few minutes later, you had where it did go up and close. It hit the R1 level again and then closed above it. So if you happen to be doing something else, you had this opportunity here again. If you did not get out here on the initial wick touch, you did have this opportunity here, and that was $24.80. Now here's where it hits the minimum 1.5 level move on the regular trade at 11.24. And as you can see here, we had a high of 29 on that wick touch, but then if you waited to the close, 27.10. Just like here, we had a candle a few candles later where it did go back up, retested, and closed above it. If you instead got out there, then it's 29.52. Next, we'll look at the 67.90. Okay, so here's the 67.90. Here's the entry candle here, $8.90. Here's the wick touch of the R1 on the scalp. High, $18.20. Close, if you didn't get out on that wick touch was 17. Here's the candle a few candles later where you could have gotten out again, where it did happen to close above it, $17.20. Here is the regular trade 1.5 level move on the high wick touch on that candle at 11:24. AM candle $20.70. However, if you waited to the close, $18.90. And then here is the retouch where it did happen to close above it, and that was 11:30, $20.20. Next, we'll look at the 67.95, which was our furthest out of the money. So here's the 67.95. Here is the 9:30 a.m. entry candle on the close, $6.90. Here is the 9:36 high wick touch R1 scalp. High was $14.90 on that high wick touch. Waited to the close, $13.80. Here was the few candles later where you had another opportunity to get out, where it actually did close above it, $13.79. Here is the 1.5 level regular trade minimum required move, 11:24 a.m. High $16.70 on the wick touch, $14.80 if you waited to the close. Here's where you got your additional opportunity here, 11:30 a.m. where it did hit the mid R1, R2 again for the 1.5 level move, but this time it did close above it. In that case, $16.10. Okay, so this is going to wrap up this video for today. We thank you for taking the time out of your day to watch this video, and if you did like the video, if you please like the video and subscribe to our channel, as that helps us out with the YouTube algorithm. And if you subscribe to the channel, then you'll be notified when we have any new videos that we come out with. Also, as mentioned at the beginning of this video, if you are interested in this indicator, you can, in return for taking your time of watching this video today, you can send us an email at daytradinggps@gmail.com and request a discount promo code to be sent to you, which will give you a substantial discount off of the price of the indicator. All of our indicators are sold on a one payment for lifetime access basis. So you make one payment and then you have access to the indicator for life, which also means that if we come out with any future enhancements or future releases of the indicator that have additional features in the future, then you will receive those since you have lifetime access at no additional charge. Now, we're releasing this video on, even though this is the Friday, October 24th session, this video is being uploaded to YouTube on Saturday, October 25th. This coming Monday, October 27th, the price of this indicator will be going up. So the current price that it's at, the current base price, will be going up on Monday. So the point is that if you do have an interest in this indicator, the discount that you'll be getting on it applied to the current price will give you a net price that will be a lot less than it will be if you wait till Monday. So if you do have an interest in this indicator, you can still use the promo code that you'll be getting on Monday. However, the base price of this indicator will be going up on Monday. So if you do have an interest in buying it, then you'll be better off buying it over the weekend before Monday hits. So again, thank you again for watching this video, and we wish you prosperity in your future trading endeavors.